So let us begin by welcoming my members or my viewers today in our first topic of financial management. It is a calculation. It doesn't mean that as per your syllabus is your first topic. So there are notes which I've already shared with you in our WhatsApp group, and they resemble the first three topics. We are just commencing from, because they are theoretical. I'm doing an assumption that once I share with you, you'll be able to revise and read them, because they are very important. So you just allow me to begin by introducing time value for money. I know very well that we have been discussing, or we have been checking on the effects of inflation in our economic space. Together with the current economic situations in our country and the increase in the price of the commodities. When we come back to determination, you'll be able to check on the value of 1,000 shillings in 2013 compared to the value of 1,000 shillings today. In 2013, we could do better with 1,000 compared to today, whereby you can just buy water, 1 kg of sugar, 1 unga, and so on. So you can see there is a time value for the money for the period that you can weigh how the value of money was compared to the current situation. So in this case, in those scenarios, we'll be able to find the same concepts when we are looking on the investment aspect, because the time value of money we discuss about investments, and in most cases it touches maybe individuals and also to the organization. Mostly the most important aspect for the investment in organization, we shall be looking on the capital budgeting, which is part of your syllabus. So in the time value of money, we normally look at on the aspect of the investment. If today I will be able to deposit a certain amount in a certain situation, or in a certain kind of investment, what am I going to be getting at the end of the day? So those kind of investment normally incorporate risks. There is a risk which is basically is incorporated there. And under that environment of risk, there is a decision that you want to make. And that is where you normally find someone choosing a certain circle compared to another one, because there is a preference. And also you have checked the expected value of a return that you want to invest in. So I just want to introduce those concepts of investment under the time value of money by saying that when we are looking on the time value of money, we are discussing about the determination of the future value, which we basically does it through the compounding, and the present value, which we normally do through the discounting of the expected cash flows. So it means I might be having a cash today, right? Determining how much that amount will be based on a certain interest rate, which is being given by a financial institution, then I will be able to determine the future value of that investment. Then another, for example, when you go to this investment under the insurance, they can be able to give you the future value when they incorporate the aspects of inflation and so on. So it is very important to understand that the discounting of the determining of, you have the future value and you want to determine how much am I supposed to be investing today. Let us engage on that kind of discussion. Now, in this case, I just want to begin by looking on the compounding, and that is the determination of the future value. And we are saying that we are determining the future value of the expected cash flows, and it is normally done using the two concepts. One, we normally look the future value of a lump sum, and also we have the future value of an annuity. And I just want to explain, these are the common terms which we are going to be using throughout our syllabus. What is a lump sum and what is an annuity? And I will be able to engage on a kind of investment where we are involving an asset. And I will be able to say, if, for example, I have an asset, right? We have an asset. I have, for example, a tractor, and I want to buy a tractor so that I can be able to plow to other people's lands. So every time I have, I have already invested certain amount, which is a capital to invest on that tractor, and that tractor will be giving me an income, right? Sometimes I can be able to put in this way, that tractor will be able to plow around 5 acres a day, and the estimates of the cost, for instance, it might be, let me put those figures in a monthly basis. That tractor can be able to give me around 150,000, right? And my project that I want to undertake is not taking more than 5 years. So let me say, within a period of 5 years, I will be able to kick out my projects, right? And close my entire project, which I'm doing. Remember, the tractor is going to be giving me 150,000 shillings every month, right? For the period of 5 years. So in that scenario, when you look at it, this 150, which I'm going to be getting, there is no an increase of that amount. There is no a decrease. Every month, I'm supposed to be getting a revenue. Let me talk about the profit, a cash flow of 150,000, right? For a period of 5 years. So what is this 150? How am I supposed to be calling it under the financial management? And that 150, which I'm going to be receiving, it is a constant figure for the period of 5 years. That amount is basically called an annuity, right? It is an annuity. But what about when the project of mine ends and I want to sell now the tractor? Because already you normally know that there is a loss of value of an asset when I'm dealing or when I'm plowing for that period. So it means the amount which I was able to set to buy this tractor is not the same which I will be able to dispose. So under the termination of my project, I will be able to get another cash flow. And with that cash flow, I'm going to be receiving it once, because I'm not going to be selling my tractor every year or every month. So that figure, it is normally called lump sum, the one that I will be able to get only once at the end of my period. That is why I'm talking about that is amount that is normally received once. So when we come to the investment aspect of you, you'll be able to engage a conversation where you are going to be looking at it in this way. That a lump sum basically means that an amount that is normally received once, either at the beginning or at the end of the period. And that is the definition for the future value of a lump sum. And we say, when you look at it, the future value of a lump sum, I just wanted to engage on a certain concept which we were able to use when we were at our lower classes, at our O-level classes. And in that case, you will be able to understand how the future value of a lump sum can be able to be determined. You remember there is a concept which I will be able to show through our board, which we used to use the amount is equal to the principal 1 plus n, and so on and so forth. I will be able to convert that information and transit it to what we are discussing today. So that is why we are saying it may also include payment of irregular cash flows over a period of time. When we discuss about irregular cash flows, these are cash flows which are not the same. An example of these cash flows might be, right, for example, on year 1 of my project, I received 150,000. Year 2, I received 155,000. Year 3, we received 160. Year 4, we received 120,000. Right? When you look on those figures, that is what we discuss about irregular cash flows. And it might have a period of time being included in it. So we apply the compounding formula when determining the compound future value of a lump sum. And that is why we have said that we normally use the amount is equal to the principal, 1 plus r u raised to power n. And I'll just be able to share this concept with you through our board. And that is why I said it's very important when you're writing. So let us go to our board, and I think it is visible to you guys. Is visible? Is visible? You can unmute it.
Yeah, it is visible.
Thank you. So I don't know the principle. There is only a concept which I understand about accounting. I don't understand a lot of English, but the future value of a lump sum, because we have said we just want to look on the compounding. We just want to look on the compounding techniques. And we have said, under the compounding techniques, we are going to be doing it 2 phases. We have talked about the future value of lump sum, And we have said a lump sum is amount which is received once. So just allow me to write here once. Then number 2, we have the future value of annuity. And when we discuss about annuity, it means several times over a period of time. Several times. Those are the conversation which I just want us to make. Now, from there, we have discussed about analysis when we are using the future value. The future value of a lump sum, right? The future value of lump sum, we have said that during this period, it means the payment of an amount only once, either at the beginning or at the end of the period. That is what we have discussed about the future value of a lump sum. But in that concept, we have said, we normally apply the compounding formula when determining the compound value of the lump sum. And the compounding formula of ours which we want to engage, we have said, we normally take our amount, which should be equal to principal, right? 1 plus r, we raise power n. That is the concept which I just want us to use tonight. A minute, please. So in this case, we just need to understand what is an amount, what is the principal, what is our R and N. So in this case, I will be able to say when we are discussing about amount, right? This is the future value. These are the terms we use under the financial management. What about our principal? And our principal, we are saying it is our present. That is our present value. But what about our R? We know that if we want to invest, this is normally the future value. This is our present value, right? So when we are discussing about our R, this is our interest rates. Because I know very well as an investor, you cannot be able, you cannot be told that invest with ours, but there is no interest rate. Then you will not be able to invest. Then we have our N, which might be in two phases, the number of the periods, stock, right? The number of the periods, stock, years. The number of periods, stock, years, right? So in this case, it means in financial management, we don't use this, right? But we are borrowing it from form of high school. So in this case, we normally say our future value should be equal to our present value. 1 plus r, we raised to power n. That is a concept which is basically mostly used. It's a concept that is highly elaborated. So in this case, I just want to have an illustration. We just want to have an illustration. And in our illustration, we can say, if an amount of Kenya shillings, 200 is invested today. If an amount of 200 is invested today at an interest rate, if an amount of 200 shillings is invested today at an interest rate, is invested today at an interest rate of 10% per annum for a period of 5 years. For a period of 5 years, its future value will be can you give me a minute? I just want to know why my screen is not clear. Just give me some minutes, please.
You're on mute. We can't hear you. Hello, mwalimu. You're on mute.
Thank you so much. Thank you. I have said, based on the illustration which we have, is that even amount of 200 shillings invested today at an interest rate of 10% per annum for a period of 5 years, the future value will be, so in this case, I have said, you just need to use your formula and you say, my present value will be Kenya shillings 200, which I just want to make an investment today, right? Then we have our rate, which is 10%. Then we have our N, which is 5 years, correct? So in this case, you just need to determine the future value. I will be able to say, to get my future value, will take my present value. My present value is 200, 1 plus 0.1, you raise to power 5, power 5. I have said, you just need to take the 200, which is your invested today, investment today, 1 plus rates, then you raise to power 5. Who is going to be giving us our answer? Is giving our answer of the night, our first solution. Right, so it is 1.1, I raised power 5. How much is this? Someone? What will be our future value here? Someone?
322.
322 shillings. 322 shillings. 322 shillings. That is the future value. That is the future value. Now, in this case, in financial management, the future value, the 1 plus R, you raised for N. The 1 plus R, you raised for N here, right? It is normally called, it is normally known as the future value. It is normally known as the future value interest factor. The future value interest factor. That is the mean. It is normally known as the future value interest factor. And in this case, we are putting it in this manner, the future value interest factor. That is what I'm going to be writing. R%, which is our rate now. Then we have N years. R%, N years. These are some of the symbols which you'll be able to see me using as we move forward. So that you know it is very captured. So let me just look on the second illustration of so that we can be able to analyze and understand the concepts. Let us analyze it. So I know there is someone who is writing. So let me not rub everything. So illustration 2. Illustration 2. We are saying that even amount of 120,000 shillings even amount of Kenya shillings, 120,000 shillings, 120,000 shillings is invested today. Is invested today. Even amount of 120,000 shillings is invested today at an interest rate. Let me talk about 10%. At an interest rate of 10% per annum for 5 years. 10% per annum for a period of 5 years. Right? Its future value would be, so this would be very easy. I just want to write my formula first. So it will be the future value is equal to the present value, 1 plus R raised for N. And I know very well that my present value is equal to Kenya shilling, 120. I know Sheila knows that. Then we have our rate now is equals to 10%, and our N is equals to 5 years. Someone even should be giving us the answer. So the future value will be equal to 120. 1 plus 0.1, I raised to power 5. How much it is? How much it is in Kenyan shillings? How much it is in Kenyan shillings? Someone? I'll give out the solution.
193,261.
193?
261.
Correct. 193,261. 100. Even yourself, you can see there is already the determination of the compounding effect. You can be able to check on it. I invested 120. I can be able, the future after 5 years, will be able to get 193,000. That is what the SAC course normally discusses about the power of money. Money can work for you. That is what the concept in which the SAC course normally use to convince the clients, people like you and me. Now, in this case, let us look on the other scenarios in which you can be able to get those problems in a question, and we say, determine the future value. Because there is a problems in which I see examiner normally brings, determine the future value, determine the future value of investments, the future value of investments, investment above. Determine the future value of investment above, right? If the interest was earned, semi-annually. If the interest was earned semi-annually. So how am I going to be working with this? Because already it means the interest rate which we have been given here, our rate is 10%. But this should be per annum, you know that. But in this case, semi means twice, right? Semi is twice. So how am I going to be doing my question? It means that the rate now we are supposed to be dividing it by 2, right? To determine the rate for 6 months. And in this case, my rate for 6 months will be 5%. What happens also with the N? There are only 2 things which are basically affected here. Our N will be also doubled, because already you know, in a year, I normally get my interest twice. So what is happening with 5? Sorry, what is happening with a period? It means it is going to be doubled, and I'm going to be having 10 periods. Therefore, right, the future value of mine now, right, we have already invested 120,000 shillings, right? We multiply it by 1 plus our rate now, 0.05. Then we raise to 10. How much is this, Sheila? How much is this? How much is this? How much it is? If you are following someone. Someone to show the answer.
195 for 67.
Sorry?
195 for 67.
195 for 67. 195 for 67. Someone might be asking you a question. What is the difference between the two concepts? What is the difference between this concept and this? What is the difference? And you can be able to tell that person that the difference is because of the compounding effect, right? It is the effect of the compounding effect. And that is why you normally find it in any time after the first period. Interest is going to be earned on interest and principal, because after 6 months, I will be able to get some interest. That interest is going to be incorporated under the capital of the principal amount. The principal amount will be more. So the moment I'm going to be the moment we are going to be calculating the second interest, it is going to be an interest which I earned in the first period, 6 months, together with our principal amount. I know that you are able to understand that concept very well. I just want to look on a different concept, and it is normally called the future value of an annuity. Let me get back to my notes. If you are writing, you can tell me, Mwalimu, wait. Have we completed writing? Anyone who is writing now? You can raise your hands. You can raise your hand. That is the only way we can communicate. Or you chat, you say yes or no. So you can be able to communicate in those ways. So let us proceed here, because already we are done with the first one. We talked about the future value of a lump sum. We have the future value of an annuity. Now, before even I go further, there is a question in which an examiner tried to get it out of this. And this question was tested on two phases. There is two questions you can be able to check on that. One was okay. There is a question December 2022, question 1.3. Question 1C, sorry. December 2022. So let me check on that first before we go any further. Do we have our link for question? If yes, raise your hands. Do we have the link for our question? If yes, you raise your hands. Do you have it? Do you have link for our questions? Yes, Wanja? Talk to me, Wanja. Can you talk with me?
I'm saying I'm answering your question.
Oh, okay.
I have the link, the one that you sent.
Can you share it in our chat box?
Sure.
Someone who has accessed the questions? Okay, so let us go there. I was discussing about December 2022 here. December 2022, we have a question. Equapi Financial Management, CA22. We also need to know our paper number. So we have this question, question 1C. Who is reading for us now, kindly? Someone? Kindly read. Let me start with Wanja. Wanja, can you read for us, please? So that we don't waste time.
Okay. Your client, Alfred Otieno, wishes to invest 500,000 for 2 years with interest compounded, but with the rights to withdraw at a moment's notice. The following investment options are available. Option 1, invest with Nyumba Building Society, currently offering an interest rate of 14% per annum after tax with interest paid half yearly. Option 2, invest in Kijiji Bank Limited at an interest rate of 17% per annum with interest paid annually. Option 3, invest in Faida Bank Limited, which is offering 16% per annum, interest paid every 3 months. Using suitable computations, advise your client on the best investment option he should consider.
Number 2, we have been told to calculate the effective rate of interest for option 1. Then number 3, we have been told to identify 2 solutions that could affect your recommendation C1 above. Thank you so much. So in this case, when you come across this kind of a question, I know that you are already opened in your gadgets. So this question, when it comes, just do with each session or each option as provided. So let us start, let me give a solution here. So in this case, we have said, to get our future value, we take our present value, 1 plus r raised to power n, correct? So let us start with option 1. We start with option 1. What does the option 1 says? Right, we have been told under the option 1 that invest with Nyumba Building Society, currently offering an interest rate of 14% per annum, but that after tax, with the interest is paid annually. So in this case, I just want to determine my present value, which is 500,000. Correct. Then we need also to determine our rates. Our rate, we are being told it is going to be paid semi-annually, but the rate which is given is 14%, which is per annum. You just need to divide by 2 to get the rate for half a year, which will be 7%. Correct. Then you know very well the period will double because per year you're going to be getting twice. So the investment is going to be done for how many years? You know very well it's 2 years. So it will be 2 years times the period, right? So the period is going to be initiated by the number of periods or the number of times in which you're going to be getting your interest. And it is 2 times in a year. So in this case, it changes from year and it will be period now. So to get my future value now, I just need to take 500,000. 1 plus 0.07 raised to power 4. How much is this in Kenya shillings? How much is this in Kenya shillings? Let me know your name so that I will be able to call you as we move forward. Yasmin, can you give me the answer, please? Yasmin, what is the answer? How much is the answer? Sheila, how much is this?
That's 655. Okay. 655,398.
Thank you so much. It should be 655,398. That is option 1. Option 2 is giving me how much? So I just need to go back to my question and determine. So when you look on option 2, we are being told what? The option 2, we are being told, right? Invest with Kijiji Bank Limited at an interest rate of 17% per annum, which is paid with interest paid annually. So in this case, it means to get my future value, I will be able to take my present value, which is 500, right? Then we multiply by our rate. We are being told it is 17% per annum, which is 0.17. We raise for how many years? We are being told it is only 2 years, correct? So how much is this in Kenya shillings? So 1.17, I raise power 2, right? Then I multiply by 500,000, and I'm getting around 684, 450. 684, 450. You know, you are following. Then we have option 3. We have option 3. What does option 3 tells us? We are being told that invest with Faida Bank Limited, which is offering 16% per annum, interest paid every 3 months. And then it means that we just need to determine the quarters that we have in a year. We normally have 4 quarters. So in this case, the rate is going to be affected. Why? Because our interest rate in this case is 16%. But in a year, you have 4 quarters. So our rate will be 4% per 3 months, right? Then what is happening with the number of years? Our number of years will, we are going to be multiplied by 4, so it will be 2 times 4. And the 4, it is for the quarters that we have in a year. And you're going to be having 8 periods. You're going to be having 8 periods, right? So the future value of years now will be 500,000, 1 plus 0.04, then we raise power 8. How much it is in Kenyan shillings? How much it is? Are you getting something closer to this? 684, 285. 684, 285. The question will be, because the examiner is asking you to recommend the option, let me go to the question and read it. Using the suitable computations, advise the client the best investment option that he or she should be able to consider. So in this scenario, you are just going to be looking on the future values. Which one has the highest return? And in this case, we can see option 2 is recommended. Let me write here. Option 2 is recommended. Option 2 is recommended since it has the highest, return. Option 2 is recommended since it has the highest return. That is why, because when you compare between the 3, this one is the highest. That one is the highest. That one is the highest. There is another requirement there in which the examiner is asking you to consider. Examiner is asking us, right, in option 1 now, the problems have been taken back to option 1. Calculate the effective rate of interest, right? Effective rate of interest of option 1. So the question will be, how am I supposed to be calculating this effective rate of interest? How should I calculate it? So to get the effective rate of interest, the effective rate of interest is very simple, because already you have the future value, right? We have our present value, right? So it will be 655,388. Correct. We should be equal to our present value, which is 500,000. Correct. Then 1 plus rate, we raise to how many years? How many years are we supposed to be raising? Our investment is just taking 2 years. So in this case, we divide here by 500,000. And also you divide here by 500,000. Right. So what is our division there? How much would be our division? So in this case, it will be 655,398. You divide by 500,000. I'm supposed to be getting 1.311, which is equals to 1 plus rate, you raise power 2. The question will be, how am I going to be removing that 2 up there? Right? So it means we have to use the roots. So it will be to the root of 1.311, which should be equal now to 1 plus rates. To 1 plus rates. To 1 plus rates. So how am I going to be doing this? Just look on your calculator and you press letter 2 from your keyboard. Then you press your shift, and there is a button in your calculator which looks like this. There is this button in your calculator. So it will be shift that button. Then you put your answer 1.311. 1.331. So how much am I getting? For this person who is following, it is 1.144. We should be equal to 1 plus rate, but we need the rates. So it means we have to be taking 1 on the other side. It will be 1.144 minus 1, getting the rate. So our rate should be equivalent to, because this is 0.14.4, it will be 14.4%. 14.4%. Let me repeat this. Once you get your answer, you can be able to remove these with your roots. So how am I going to be doing it? You just need to press 2 from my keyboard, then shift and this button. You will see this button of yours, shift and that button. You're going to be having something looking like this, right? And then you put my answer, which is 1.311. Then I'm going to be getting 1.144. 1.144. I know that already it is, you have already understood how you can be able to do that. Now, let us go to another question, because number 3, we are being told, identify 2 situations that could affect your recommendation C1 above. What is going to be affecting my investment? There are only some few elements which can be able to affect your, which is going to be affecting your investment. 1, right? Number 3, we can only be having the problems here. Number 1, we can discuss about inflation, right? We can have inflation. Number 2, we can talk about the risk of the market. The risk involved in the market can be able to affect, the outcome of this. Then number 3, we can talk about the attitude, right? The attitude of the investors. The attitude of investors also can play a part in determining the effect of the outcome, the effect of your outcome in that. And also you can be able to put as more points as you can. So, are we writing? Rangma, are you writing?
Writing.
Yes.
Yeah, I'm writing.
Yasmin? Yasmin, she's, I don't know whether she is but I think she is. Let me see. Yes, she has commented. Have we finalized the writing? Yasmin is writing. Very good. Yasmin is writing. That is okay. Correct. So let me proceed. Let me proceed. Correct. So we were looking on the something different here. We were discussing about the future value of lump sum that we have done. So I just wanted to look on the future value of an annuity. The future value of an annuity. And we are saying annuity refers payment of a fixed period amount over a given intervals. And that is why we are saying the receipt of fixed amount for a given period. I have given a small illustration there, but let me reconstruct that illustration using a better figure so that you can be able to understand. Right, very good. So in this concept, the future value of an annuity, I'll be able to refer to different questions, but I'll be able to show you how it's normally done. So in this scenario, right, in this scenario for the future value of an annuity, let me just look for an illustration here, because we are discussing about number 2, the future value of annuity, the future value of an annuity. So I just want to look for illustration, right? For an illustration. So when I'm doing my illustration, right, it means that we are talking about even amount of Kenya shillings. Let me talk about 150 shillings is expected at the end of each year. Is expected at the end of each year. Is expected at the end of each year for a given period, for the over a period of 4 years. For a period of 4 years. For a period of 4 years, at an interest rate of 12%. At an interest rate of 12% per annum, its future value would be. So in this case, when you are given us this kind of a question, you can be able to use this kind of a formula. Let me just put it as an NB here. Let me put as NB there. And I say the future value, interest factor annuity, the future value interest factor, annuity can be determined. Using the formula. Which formula can we be able to use here? We are said to get the future value interest factor annuity, R percent 10 years. We can be able to use this kind of a formula. We say we don't want to struggle a lot, so I will be able to use this kind of a formula, -1, we divide by our rates, right? So in this kind of investments, because we know very well that our investment is for 4 years. So how can we be able to determine what is our present value? We know very well our present value is 150. So it will be the future value of this annuity, 1 plus our rate. How much is the rate? Plus 0.212, sorry, right? We raised to how many years? We have been told 4 years, -1. Then we divide by how much? We divide by our rate, which is 0.12. Once we are done with all this, correct, we multiply it with our present value, which is 150. So the future value, the present value, yes, the future value. So how much is this? How much is this? We multiply with our cash flow. So how much are we getting? So I start with the brackets. 1, it should be 1.12. We raised power 4 -1. You divide by 0.12. I'm getting something closer to 4.7793. Then you multiply by 150. How much is it in cash shillings? How much it is? I'm getting something closer to 717. 717. That is what I'm getting, 717. Right? Alternatively, and this is the concept which we are going to be using up there, we are going to be using a table, for instance. So I will talk about this investment being done at the end of the year, right? I have my cash flows here. We have the discount factor at a rate of, our discount factor, which is the cost of capital, is 2%. Then here, we are going to be determining what? What are we going to be determining at the end of the day? We are determining our future value because we want to determine the future. What will be the future value at the end of the day? So remember, from year 1 to year 4, we are going to be receiving, this is what it means for annuity. Year 1 to year 4, we are going to be receiving a cash flow of 150, right? What is the discount factor? How much did you get here? We got 4 points. We got 4 points. 7793. Right? And when we multiply, I know very well that Yasmin is able to get 717. 717. You can be able to use this one. You can use whichever the methods you feel it is good for you. You can use this one. Someone else will be able to use this concept, right? And all the students will be okay with that. Will be okay with that. So when you look on your notes, we'll be able to see, we have said that to adjust for investment at the beginning of each period, we assume that the investment is at the end of the period, and then we are going to be multiplying it by 1 plus R. Those concepts, you can be able to check on them later on. But the most important area, which I just want to focus on, it is the discounting techniques, because they are the mostly tested in the exams and also mostly applied the most applied in your concepts as you move forward. So the most important aspect, which I just want us to get keen on, they are the discounting techniques. The discounting techniques. So when you look on the discounting techniques, we have said that it involved the determination. Remember, we were doing the compounding, where we were taking the present, we take the future. Now we have the future, we want to take it to the present. And that is where we have said that this is the opposite of compounding, because we are determining, it is involved the determination of the present values from the expected future cash flows. And we normally have 3 concepts. So let me just go to my board so that I can analyze them, right? So based on the discounting techniques, we have 3. Discounting techniques. So under the discounting techniques, right, we have said they are normally grouped into 3. The present value of a lump sum, the present value of a lump sum. Number 2, we are going to be having the present value of an annuity, correct? Number 3, we are going to be having the present value of an annuity to the present value of an annuity to infinity. So let us start with the first one, the first concept, which we are calling it the present value of lump sum. What is our present value for lump sum? Do you remember we said that the lump sum means the payment of fixed amount of interest, the fixed amounts. This means payments of fixed amounts only once, either at the beginning or at the end of the period. It should be once. They are not going to be twice. It's going to be only once. Can you be able to see my boards? Is my board visible? Thank you. So let us continue. And I think I'm audible enough. So in this case, I just want to look on illustration here. Just look on a small illustration to make you understand better. Right? We have said, if an amount, if the present value, right? Correct. So let me put in this manner. The present value of Kenya shillings 500. The present value, determine the present value of 500 shillings expected after, let me talk about 5 years. At an interest rate of 12% per annum. Let me talk about determine here. We determine the present value. Determine the present value of 500 shillings expected at 5 years at an interest rate of 12% per annum. So I will be able to tell you that because we said it is the opposite of the compounding, because the compounding formula can be expressed in the present value, and we can be able to recall. You remember we said the future value is equal to the present value. 1 plus r raised to power n. But in this case, we say make the present value the subject. Right? So in this case, we know very well it will be the future value is equal to the present value. 1 plus r raised to power n. You just divide here by 1 plus r, you raise to power n. Then you divide here by 1 plus r, you raise to power n. That and that one goes. So our present value will be equal to what? It will be the future value. You know, when you multiply with your denominator here, we are going to be having a negative effect on our power. That is a mathematical concept. So in this case, we multiply by 1 plus r, we raise to power negative n. The negative n kama ushaifanya FM ilitokanga hapo. Once you reciprocate this, then our power is going to be affected by a negative. So in that case, remember, as per our illustration, we have the future value, right? We have our future value. So our future value is how much? And I will be able to say our future value is Kenya shillings 500. The future value is 500, right? Our interest rate is 12% per annum. Then we have our n, which we have said it is 5 years. What will be our present value? I will be able to say, to get my present value, I will be able to take my future value, 1 plus our rate, 0.12, we raise for negative, we raise for negative n, we raise for negative n. How much it is? In simpler terms, it is just taking 1.12, I raised for negative 5 times 500. And I know very well, each one of you is getting this figure. Equivalent, 284. 284. This is what we are getting. This is what we are getting. Let me see, someone is talking to me. Thank you so much, Rama. So we are getting an equivalent to 284. That is what we are talking about. Now, can I be able to look on the second illustration? Or I just wait till you write. You can be able to write. You can be able to write. So let me just write an NB here as we continue writing our NB here. Right? We are saying 1 plus r raised to negative n is known, it is normally known as the present value interest factor. The present value interest factor. And our present value should be equal to what? So in this case, we say, in short form, it is normally written as the present value interest factor, R% n years. And that is why I say exam may answer, because when you look on the back of your paper, this is what we are going to be finding there, right? This is what you're going to be finding. The papers normally gives you this, or 1 over 1 plus r, we raise to negative. And this is what the papers are giving. So that is what it normally means, the present value interest factors. It is normally written like this. So if I wanted to determine mine without using a calculator, but you know, this one, the formula of it, or now you can be able to get. So I could have written my my question like this. The present value is equals to 500 times the present value interest factor. What was our rate? Our rate was 12%, 5 years. 12%, 5 years. And then I come here and I tell my examiner, now in this case, I can go to my table and look for this, right? Let me show you how. If you can go to your table here, if you can go in your table, let me see whether I have opened any question, whether it has any table down. This one doesn't. Let me try whether I can get one. a minute, please, so that I can show you how it is normally done. The tables are always provided. Let's see for the August, whether they have the table. They don't have. Okay. What is the period which has the table? Let me check. So that you can know how the tables are normally checked. This one as. So you can see the present value of, you can see the formulas which I've already given. The one which you can see on your screen. You can see? So already examiner has given you that table. So my thing that I need to do, or the thing that I need to do, is to check on my period. As for our case here, we are talking about 5, which is here, which is the number of years. Then you go using this row up to the area where you'll be able to match with your rate, interest rate. And our interest rate will be able to show us is the 0.5674. I can just multiply straight without even doing the calculation. So that is what I was meaning. So in this case, you can be able to just take it directly. 0.5674. Even if when you use your calculator here, you're supposed to be getting this straight away. We multiply by 500. We got 284 equivalent. And that is what I meant. That is what I was able to mean. So I know very well you are able to understand the concept of semi-annually and so on and so forth. So on and so forth. So let me see whether I have a question which they brought from our past paper. And when you look on the April 2022, let us look on April 2022 here. When you look on this 2022 April, the financial management paper will be able to give you a leeway on how this is basically done. So let us check there. So it should be question number 2A. Question 2A. Question 2A. Rahma to read for us. Rahma, can you read for us, please? Question 2A.
Okay. Question 2A. James Chege intends to accumulate 10 million shillings in his bank account 15 years from now. Required. The amount he should deposit now, assuming the bank is offering a 5% interest rate per annum compounded semi-annually.
Thank you so much. I can see there are two concepts here used. The examiner has told you that we have semi-annually. We know it is twice per year. So in this case, to get my question, because already I've been given the future value after 15 years is 10 million. What is the present value? So in that case, you just need to do this. You just come and you write your formula. Never forget to do so. So the future value of mine will be equal to the present value. Sorry. So our present value should be equal to our future value. 1 plus r, we raise for negative n. And the examiner has already given you the future value. He has told you it is 10 million. Our rate is going to be affected because we are getting twice a year. So what is our rate in this scenario? So the rate which is being provided by the examiner here, it is 5%. 5% here. So this is per annum. So if it is for 6 months, I divide by 2 years as to 2 periods. So in this case, I'm getting 2.5%. Correct. What about the number of periods? Our n goes up because already I'm using 15 years, right? But every year I receive interest twice. I multiply by 2 and I get 30 periods. Correct. So what is my present value? And I say, we take the future value, which is 10 million. Right? We multiply by 1 plus 0.025. Then we raise power 30, which is negative. Or 30 there. So how much am I supposed to be depositing today? That is what the examiner is asking. If in the future, after 15 years, we'll be able to get 10 million, what is the amount today? So 1.025. We raise for negative 30 times 10 million. I'm supposed to be getting Kenya shillings 4767 427. This is the amount which I'm supposed to be investing today so that I can get 10 million after 15 years. After 15 years. That is how the concept, and you can see these concepts, we are not don't take them lightly because already you see they are being tested in your exams. So let us proceed to the next one. The next concept, unless we are writing. No, we are done. Are we done? I know we are done, yes. So let us get back to our notes here. So the second one, because already the discounting technique, the first one we have already done and understood. The second one is the present value of an annuity. And when you have a question, don't hesitate to raise your hand. So in this case, when you look on the present value of an annuity, we have said, annuity means the payment of periodic fixed amount at fixed interest. And even amount of, let me just look on illustration so that I can apply those formulas and I show you how they are normally done. So when you go back to your board now, we are discussing on the second concept. We are discussing about the present value of annuity. I just want to give an illustration here. Just want to give an illustration because when we talk about the annuity, we know it is several times. So in this scenario, I just want you to understand it this way. And once I give an illustration, even amount of Kenya shillings. How much can I use? Let me use 300 shillings now. Is expected at the end of each year. Is expected at the end of each year. Is expected at the end of each year at an interest rate of 2%. At an interest rate of 2% per annum. An interest rate of 2% per annum for 4 years. For 4 years. Its present value would be now in this case, I just want you to understand this under NB here, that our present value interest factor annuity in short form is normally written like this. The present value interest factor annuity R% N years. R% N years. This is what we are going to be using even in my computation moving forward. And this normally portrays our annuity at the end. Remember the other one not have A at the end. A means annuity. And once it is included there, already factor it's as key as something which is very important because it means something different. Now, when you look on the definition, based on how we normally get this, the formula for getting it, we normally take 1 minus 1 plus r, we raise to power negative n, we divide by r. Just want to teach you how to apply it using the current illustration. And in this case, our rate is 12%. So it will be 1 minus 1 plus 0.12, we raise to power negative. Our number of years now, our n is 4. Then we divide it by 0.12. Then we multiply it with our future value, which is 300. This one is going to be giving us our present value. It's going to be giving us our present value. So if you do it using the formula, and we do using the table, because you know the other table, which is down there, resembles the annuity aspect. So it will be 1.12. We raised for negative 4, right? Remember, I have started from the brackets. 1 plus 0.12, we raised for negative 4. Then I take 1 minus answer, then I divide it by 0.12. What I'm getting is 3.0373. We multiply it by 300. How much it is? So once I multiply it with 300, I should be getting how much? How much are we getting?
911.
911. We should be getting 911. Should be getting 911. You see someone is saying something here. 911, thank you. Correct. So do I have that concept? No, that is a concept that which we'll be able to use mostly in our illustrations as we move forward. Now, I just want to do the last one. And the last discounting technique will be, number 3. We said the present value of annuity to infinity. What is the present value of annuity to infinity? And when you talk about the annuity to infinity, it means, when you look on the annuity to infinity, it means payment of, let me just write it here, payment of cash flows, right? Payment of cash flows for unknown period. It is the payment of cash flows for unknown period. Now, in this case, it means that we are going to be converting this, and we say to get the present value interest factor annuity for the annuity to infinity, the rate is always known, but we are moving up to infinity. The period is the one which is unknown. So how do we normally get this? And I say this is normally gotten by taking 1, you divide by rates. The present value interest factor annuity up to infinity, we normally take the rate up to this one. So it means we are normally get it by taking 1 divided by rate, 1 divided by rate, 1 divided by rate. So I just want to give an illustration. I just want to give an illustration here. And this illustration is very crucial to you. Very crucial. So I request you understand that. Very crucial for understanding FM. Remember, we are building our basics. So calculate the present value of the following cash flow components. We say, calculate the present value of the following cash flow, components, Now, in this case, our cash flow will be, let's talk about the end of the year. Correct. We have our cash flow here. Correct. Right. So we have just been given the two. Then I'll be able to give the discount factor later. So let the periods are given like this. We have 1, 2 to 5. Right? We have 6 to 9. We have 10. We have 11 to around 15. Then we have 16 to infinity. 16 to infinity. The cash flows provided. Here we have 2,000 shillings, but it means it is our initial outlay of the initial investment amount. So here we have 15,000 cash flow. We have 10,000, we have 5,000, we have 4,000, then we have around 6,000 there. Then the discount factor, which is our cost of capital, let us use around 12%. Right? To determine what? Your present value. So the biggest question is based on how the years are being given here. How our years are given here. They resemble something. Because already we know we are calculating the present value. I just need to determine how my years are given. Right? And I can see there are only two things here. Year 1 and year 10, this is a lump sum. Correct? So the other ones, this is annuity. Already we can be able to now build the knowledge which we have learned from our continuing class. We look on the formulas for both. Because we know that we are doing the present value, the discounting technique. How am I going to be determining the formula to get this lump sum of mine? Very good. I say, I normally take 1 plus r raised to power negative n. But what about these values here? We normally take 1 minus 1 plus rate raised to power negative n divided by r. The other question which you are supposed to be asking yourself, what is happening to this? Let me call ranges as per statistics. So what is happening to this range? It means we have to be getting a rate for year 2 to year 5. It means here, under the 5 years, they are supposed to be excluding year 1. Right? It is supposed to be excluding year 1. When we go to 6 to 9, it means we just need the rate for 6 to 9, which we are going to be using as our discount factor, excluding 5 years. So how do I normally calculate it? Let us start with the year 1. So our rate is 12%, and here is year 1. Don't tell me year 2, year what. It is year 1, because we are starting with year 1. So it will be 1 plus rate. Our rate is 0.12. We raised for negative 1, because we are starting with year 1. That amount is going to be received only once, or incurred only once at the beginning of the period. So if you take 1.12, I raised for negative 1, I should be getting something equivalent to, correct. I should be getting something equivalent to 0.8929. 0.8929. That even when you go to the tables, this is what we'll be able to find under under the table for lump sum 112. You'll be able to get this figure, correct? Now let us go to year 2 to 5. I will say we are going to be taking the present value interest factor annuity, 12%, 5 years. We subtract the present value interest factor annuity, 12%, right? 1 year. Why am I taking 1 year? We are subtracting year 1 so that we can get a rate for year 2 to 5. Year 2 to 5 is not needed here. So am I going to be getting it? You will allow me to use the table so that I can also teach you how to use it. 112 here looks very bad. Let us check on August. This one does not have. This one has. So when you look, this is for annuities, correct? You can see this, the present value of an annuity. And we are discussing 112. Let me show you. Year 1, right, to 12 here, we are getting 0.8929. But in this case, I just want 5. You have already have 1. So 5 to 12, which you are getting 3.6048. We are going to be subtracting year 1. When you look on 112, you'll be able to get 0.8929. So once we take the difference, let us check on that difference. Once I take my difference here, what am I going to be getting? The difference of the two will become your discount factor. Let me check. 3.6048 minus 0.8929. I'm getting 2.7119. Correct? 2.7119. Let us continue. Let me do for 6 to 9. It means I have to be taking the present value interest factor annuity, right? 12%, 9 years. How many years are we going to be subtracting someone? We are supposed to be subtracting the present value interest factor, 12%, right? How many years? 5. Because we just need year 6 to year 9. You can see now I'm subtracting year 5, this is year 5. That is year 5, correct? So in this case, you know already this one I have. This one you have. So for this one, I can use the formula now. Let me use this formula to calculate this one. And I will be able to say 1 minus 1.12 now. You know that the rate is 0.12. Then we raise for a -9. How much are we getting here? We divide by 0.12. So I just need to take 1.12. I raise for a -9. Correct. 1 minus answer. We divide by 0.12. Someone to shout the answer. The answer of ours should be 5.3282. Then we subtract for 5 years. I'm not going to be calculating it again because already I have done that job. So minus 3.6048. Even if as I go to the table now, even if I want to use the table and I look for, we were checking for 912. 912. You can see it is here. 912. 912. You have gotten 5.32, 3282. That is also what you can get using the formula. All right. So let us do our deduction here. Get our discount factor. So minus 3.6048. It is 1.72. 7234. What is happening to this one? We said this one is lump sum. So how am I going to be checking it from the table? Okay, very simple. So in this case, when you look on the table, we are saying 1012 now. And the 1012 of hours under the table for lump sum, you can see the 1012. Where is our 12 now? Correct, now I know it is visible. 10, and then you come in this way. This way. 0.3220. 0.3220. Correct. So it will be 0.3220. I know that one you have gotten it. 0.3220. Then we have year 1, 11 to 15. So to get this one, I take the present value interest factor annuity, 12%, 15 years, minus the present value interest factor annuity, 12%, 10 years. Sasa hii hakuna ile ya kuborrow the knowledge. You don't have the annuities for 10 years. But allow me to use the table to capture this. So our table is here. And now we are moving to the table for annuities. It will be 12.15 now. 15.12. 15.12. You can see it here. Where is our 12? 15.12. 6.81. 6.8109 minus the other one I can see we are dealing with 10 years. Let me check 10 years now. 10, 12. 5.6202. So what will be the difference of the same? What will be the difference? So our difference would be 6.8109 minus 5.6202. We are getting around 1.1907. What about the last one now? This one. I should say, let me get the present value, interest factor annuity, 12% to infinity, minus the present value interest factor, 12%, 15 years. And for the 15 you have, because you need 16 to infinity. So we have to subtract 15. So in this case, we subtract 6.8109. And if you can remember the formula for these, we said you take 1 over 8. So in our case, it will be 1 over 12. How much will be this? It is 1 over 0. Our rate is 0.12. So 1 divided by 0.12, we should be getting something closer to this, 8.333333 minus 6.8109. Then the one that we are supposed to be getting is around 1.5224. Then allow me now to multiply with my cash flows to get my present value. The first one will be 1.555224 times 6,000. I'm supposed to be getting 9,134.4, right? The other one will be 1.1907 times 4,000. Now I'm getting 4762.8. The other one will be 5,000 times 0.3220. We are getting 1610. The other one will be 1.7234 times 10,000, getting 17,234. The other one will be 2.11719 times 15,000. We are getting 40,000, 4678.5, 0.8929 times 2,000. I can see we are getting a negative of 1785.8. So do your summation now. So we say minus 1785.8 plus 4678.5 plus 17,234 plus 1610 plus 4762.8 plus 9134.4. What you are getting is around 71,633.9. 71,633.9. Now, from that one, I just want to give you an assignment here. The first assignment, it will be, and all the assignments should be done and shared tomorrow in our WhatsApp group. So our assignments, correct? Our assignments, you're going to be doing May 2018, question 4A. 2018 May, question 4A. May 2018, question 4A. Any question? Any question? So let me request you 10 to 15 minutes to teach the last thing of this topic, please. The last thing. I know you're still writing, so let me just wrap here. The next thing and the last one for this topic, it is normally called loan amortization schedule. Loan amortization schedule. The loan amortization schedule. Very crucial, very important. And you need to understand it because the way it is done, this is a practical thing. The way we do it here is how it is normally done by your banks. Are we done, by the way, copying? Please, someone to update me. Someone to updates. You are finished copying. Yes. Okay, Rama is done. Okay, let us continue now. I'm assuming that we are all together. So from there, I just want to look on the loan amortization schedule. We have said a loan repayment involves a fixed amount of installment payable. It should be payable over a given period. That is an annuity. The installment comprises of both the principal amount of loan and the interest payment. So the first step when you're calculating the loan amortization schedule should be the determination of the periodic installments. So to do so, let me just come back here on my board. And we are saying that one of the biggest thing under the loan amortization schedule should be the determination. You're supposed to be determining your periodic installments. So how do we normally do that? It is very important or simple. To get that thing, we normally look on the formula to get the amount of loan. They normally take, right, the amount of loan. We normally take the annual installments, which you are supposed to be paying. Annual installments. Then we multiply by, we have been told it is annuity. So we multiply by the present value, interest factor annuity, R% N years. Right? We have been told when you're calculating the loan amortization schedule, the first step is to determine the periodic installments. We determine the periodic installments, and we just say make our periodic installments subject of the formula. The subject of the formula. So in this case, it means to get the periodic installment, we are just going to be taking the amount of loan. We divide by our discount factor, the present value interest factor annuity, R% N years. R% N years. This is how we are supposed to be doing it. Now, I just want to look on a small illustration. December 2021, we have question 3B. December 2021, question 3B. Let us go there. December 2021, question 3B. December 2021. Question number 3B. Correct. Who is reading for us tonight? Let me check. Rama, can you read for us now? Rama. Mark, can you read?
Okay. Symphony Limited borrowed 15 million from Baraka Bank at an annual interest rate of 16%, repayable in each year. Required. Prepare a loan amortization schedule for the company.
And you can see, oh, thank you. You are being given 6 marks, 6 marks. So in this scenario here, when I'm being given this kind of a question, I need first to write my formula. We have said the first thing is to determine the periodic installments. So what is our amount of loan? The amount of loan in which this person is borrowing or company is 15 million. We divide by the present value interest factor annuity. What is our rate? And I will say my rate should be, the rate given as per the question is 16%, 4 years. 16%, 4 years. So in this scenario, I know when I go to my table for annuity, I will be able to get this one. Let me see if this question we are doing as one. Yes, it has. Correct. So we are discussing about 4 years. 4 years, 16%. 4 years, 16%. I go with these lines. 2.7982. 2.7982, right? You can use your table for annuity. So in this case, once I finish doing so, I will just take out my calculator where I take 15 million. We divide it by 2.7982. And I'm getting something, the periodic installment of ours will be 5360, 589. 589, right? So let me start by looking on the computation of the question. We are being told the period is 4. Once you determine the periodic installments, come up with this table. We have the number of years. We have bank balance, beginning balance, by the way, right? That is the beginning balance. We also have installments. We have interest. Installments, we have interest. We have principal. And then we have end balance. End balance there. So how much do we have? We have 4 years. So year 1, 2, year 3, year 4. The installments will be the same, by the way. So the installments will not be able to change. So you just come and you copy them here. 5360. 5360, 589, 5360, 589, 5360, 589, 5360, 589. Those ones will always be there. But what is our beginning balance? Is the amount you are borrowing. So we are borrowing 15 million. Correct. How do we normally determine our interest? You take your interest rate, which is 16%. Normally take 16%, in our case here, times bank balance. Correct, times bank balance. So in this case, it will be 0.16 times 15 million. And I'm getting here 2.4 million. 2.4 million, right? What about the principal amount? What will be the principal amount? The principal amount is normally determined. Remember, the installment normally comprises the two. The interest plus installment. They all been there, right? All of them are there. So to determine your the interest plus principal. This is principal, sorry. It should be the interest and principal. So to separate them, I just need to take 5380. So let me take my calculator very well. 5360, 589 minus my answer. We are getting around 2960, 589. Correct. So what about the end balance? It means the principal we have taken the interest, the installment minus interest. What about the end balance? I take the bank balance minus principal, minus our principal. So in this case, it will be bank balance is 15 million minus my principal. So I'm getting around 12 million 039 411. 411. I think my board is visible. You can be able to see everything. Then number two, in year two, the beginning at the end of year one becomes the opening in year two. So it will be 12 million 039 411. How am I going to be getting my interests? You multiply with the interest rate. In our case, is 0.16. We are getting 1926, and you can see your interest keeps reducing. 308. Correct. What about the principal amount? The principal amount, we are taking the interest minus the installment minus interest. So our installment is 5360 589 minus my answer, and I'm getting 3434. 3434. Don't mind about my space. 283. 283. 283. What about the end balance? You take the bag minus principal. So it will be 12,039 411 minus my answer. And I will be getting something closer to 8605 128. 86 125 86 051 28. We multiply by our interest rate 0.16, where we are getting around 13 million or 1,376,820. Then let us take our principal. We take 5360 589 minus my answer. We are getting 3983. 3983 769. What is our end balance? 5360. Sorry. 86 051. 28 minus my answer. I'm getting something closer to this. 46 21 359. So 46 21 359 times our rate 0.16, getting 739,418. Then we have 5360 589 minus my answer, and getting 46 21 171. What am I supposed to be getting at the end of the day? Should be nil. I know that the differences between this and this one is the rounding off and so on and so forth. So in this case, at the end of the fourth year, I will be able to, I should have completed paying everything. So what normally determines, even if, for instance, you can be able to check on your interest and principals, you can see the interest we started with 2.4, which was the highest in year one. But when I'm completing paying my loan, I will be able to pay the least interest. But the principal keeps increasing. You can see the principal keeps increasing, and that is how you can see the chart normally goes on. So up to that point is the completion of our first topic. I think you have enjoyed our first topic. It normally ends at that point. Then the next time when we are meeting, we should be doing the valuation models in finance. That is our next topic. That is our next topic, unless there is any question.